I have Oliver Sloup with us right now, and he's with Blue Line Futures. Oliver, you have to admit, a few months ago, we had some pretty prime opportunities to do some very, very good pricing on our ag commodities, and that includes our grain markets. And right now, things are just kind of looking tired at the end of the year here. Does this still present an opportunity to maybe look at some year-end sales and think, it's not that bad after all? Or are you willing at this point to be more patient?
Yeah, I think the quietness is offering plenty of opportunities when you look at where the volatility is trading at for the corn market. Corn volatility is at its lowest level since February of 2020. And what does that mean? It means it's a boring trade, one, but number two, it means options are relatively cheap. And now that we are, still at elevated prices, we're trading at about $1 higher than where we were at the end of last year. I think that presents an opportunity for producers to give themselves a little peace of mind if they've still got some unhedged corn in the bin, to look at some cheap options to the downside with some time left on them. So although it's a quiet trade into the end of the year, I think it presents some opportunities, and that goes for soybeans as well. Who knows what the next couple months are going to bring. A lot of the variables are going to be coming from South America here in the near term, and then once we turn the calendar over, we're going to quickly start jawboning back and forth about acres in the United States and weather in the United States. So I think it's important to take advantage of the cheap volatility, because once we start having those conversations about acres and weather in the United States, I think that premium will come back into the market, or the volatility will.
Well, the Climate Prediction Center has forecasted for quite a while that this rare third year of La Nina is expected to fade out by the time we get to February or March, maybe even flip over to an El Nino phenomenon. And if that's the case, our weather patterns would switch here in the U.S., and that could mean a pretty good growing season next year generally across the U.S. Areas that have been really dry might see the opposite effect next year. So is that something to consider, too, when you're looking ahead?
Yeah, absolutely. I know there's a lot of the bullish tailwinds to the markets, and it's, for producers, it's more fun to be bullish than bearish, but I think it's important to protect the bottom line, especially if we do, get that perfect growing season in some areas. It's, hedge when you can, not when you have to, is the old saying. Another thing we're keeping a close eye on is the fund length. They've been long several 100,000 contracts for the last 2 years. They're down to about 100,000 contracts right now, so they have been liquidating. And if we do see the weather patterns start to shift a little bit more favorably come the beginning of next year in the United States, I wouldn't be surprised to see additional long liquidation. I think a lot of people who might be a little bit, newer to the futures market might think that funds are always long grains. They're not. It used to cycle in and out, net short to net long, net short to net long, but the last 2 years they've been holding very stout net long positions, and I wouldn't be surprised to see that tide turn eventually, and I think a good weather season in the United States could be that catalyst.
That is an excellent point. I am so glad you brought that up, because I really need to drive that point home, where producers should not become complacent, thinking that prices will always remain elevated. I remember, it used to be we thought we'd never have a chance to even beat our break-even point every year. So we can't forget those times, that's for sure.